Your CPA filed everything correctly last year. Every form, every deadline, every number is accurate, and you still overpaid by tens of thousands of dollars. Not because they made a mistake, but because there's an entire category of tax strategy that most CPAs simply never bring up. And today, I'm going to show you exactly what that looks like. Here's what I want you to understand before we go any further. There's a difference between a tax preparer and a tax strategist. Most people have a tax preparer, very few have a tax strategist. And that gap is how your income is being handled, and it tends to quietly compound into a very significant number over time. And in this video, I'm going to break down why that gap exists, what most high earners are missing, and where the real opportunity tends to show up at this income level. As always, this is educational content only. It is not financial or tax advice, but if this connects with your situation, I'll share how to take it further at the end. Let's start with something most people don't realize. Your CPA's job, in most cases, is to look backwards. They take what happened last year, organize it correctly, and file it on time. That's what a tax preparer does, and they do that job very well. But here's the problem. By the time your CPA sees your numbers, the year is already over. The income already came in, the tax bill is already set, and at that point, most of the strategy window has already closed. This is why so many high earners doing everything right still end up writing a check to the IRS that feels much bigger than it should. Not because they did anything wrong, but because nobody was thinking ahead in the strategies that actually move the number. The ones that create the real tax efficiencies, those don't happen in April. They happen in how you position your income, your investments, and your structure throughout the year. That's what most CPAs never bring up. Not because they're hiding it, but because forward-looking strategy isn't what most of them are hired to do. Here's the pattern I see consistently at this income level. Someone earns $250,000 or more, they work with a good CPA, they max out their 401k, and maybe they have some real estate. And every April, the tax bill still feels disproportionate to what they expected. Their income went up, the bill went up with it, and the conversation with the CPA is usually the same. Here's what you owe, here are a few things you could do differently next year. But then next year comes around and the same pattern repeats. This is what reactive tax management looks like. And at lower income levels, it's fine. The numbers are smaller, the exposure is more limited, but past a certain income threshold, reactive stops being good enough. Because at 200,000, 300,000, and above, the tax exposure compounds fast. And the strategies that could have helped, they needed to be in place before the income arrived, not after. So what does being proactive look like? It starts with one question that most high earners have never been asked before. How is your income structured? And is that structure working for you or against you? Because here's what most people don't realize. The tax code doesn't treat every dollar the same. W-2 income is taxed one way, business income is taxed another way, and then investment income follows different rules entirely. And within each of those categories, there are different structures, vehicles, and timing decisions that change how much of that income is actually exposed. Most high earners are operating at full exposure, not because they made a bad decision, but because nobody helped them design anything different. And this is where certain investment categories tend to come up in more serious conversation. One example that often surfaces for high earners in the 200K to 500K plus range is oil and gas working interest. Not because it's the right fit for everyone, it isn't, but because the tax treatment mechanics behind certain oil and gas structures are different from most other investment categories. Things like intangible drilling cost deductions, where in many cases a significant portion of investment costs may be deductible in the year they're incurred, tend to change the math in ways that many other assets simply cannot provide. This is the kind of thing a proactive conversation surfaces, and it's also exactly the kind of thing that almost never comes up in an April meeting with a tax preparer. Here's why this stays invisible for most people. At this income level, there's a false sense of security that comes with having a CPA. Most high earners assume that if there was something significant being missed, the CPA would flag it. But the reality is most CPAs are optimizing for accuracy and not compliance, not for minimizing your exposure going forward, and they're not doing anything wrong. That's what most of them are hired for. A conversation that starts not with what do I owe, but with how is this entire income structure designed to perform over the next 5 to 10 years. That one shift changes everything because you stop reacting to a number in April and you start designing how your income flows before it arrives. For those of you that don't know me, my name's Bennett Walsh. I work with high earners, W-2 professionals, business owners, and investors who came in having done everything right with their CPA and did everything that they recommended, maxed out their retirement accounts, managed their deductions, filed on time, and still felt like they were leaving too much on the table every single year. In most cases, the issue wasn't that their CPA was wrong, it was that the conversation had never gone far enough. Once it does, once you start looking at how your income is structured and what categories it's flowing through and what options are actually available at your level, the picture looks very different. Not dramatic, not overnight, but intentional and compounding in a direction that actually makes sense. If this is something you've been thinking about but haven't fully explored, comment the word strategy below. I'll share a breakdown of what these conversations typically look like for high earners at this income level. And if you want to take a step further, there's a link in the description and you can book a one-on-one call directly with me. We'll take a look at how your current income is structured and whether there's a smarter way to position it going forward.